Welcome everybody to the Daily Horizon View. Today we're going to look at Friday the 6th of September 2019. As always, we're checking up on the ASX Exchange Traded Funds. This is my little top 5 series just to keep you guys up to date. Today our spotlight is on SSO, which is the State Street Spider S&P ASX Small Ordinaries Fund. Let's crack on. We are here to crack your financial sky. We want to give you information and demystify the world of finances. Right, everybody, let's sink our teeth into the top 5 percentage rises for Friday. We saw SSO, UBP, Food, ROBO, Robo, and MBS. So let's just quickly touch on SSO. That is also the spotlight for this week. So if you want to just look at the spotlight, you can flick to the end of the presentation today, or the show I should say. SSO is the State Street Spider S&P ASX Small Ordinaries Fund. So that tracks the performance of the S&P ASX Small Ordinaries Index. Market cap of $23.3 million or thereabouts. You'll get a dividend yield of 2.32%. Morningstar give this a neutral rating. If you need to think about that in a star context, that is 2 out of 5 stars. So today we saw SSO up 1.72%, which equates to 26 cents on a smallish volume of 431 shares traded. Okay, let's cast our eye over the top 5 percentage falls for Friday. GDX, ETPMAG, ETPMPT, MNRS, ETPMPM, so pretty much all metals related or mining related ETFs. So GDX is the VanEck Vectors Gold Miners ETF that tracks the New York Stock Exchange ARCA Gold Mining Index. This one has a market cap of $16.2 billion, so I think that is the largest ETF traded on the Australian Stock Exchange. We saw a fall of 4.73%, which equates to $2.13 on pretty healthy volume of 46,700 shares traded. So, you know, looking at the codes, I can tell you that everything is metals related there, as I may have mentioned before. So China's come back to the negotiating table with the US regarding the tariffs. So all the hedges against volatility are all down. Okay, let's cast our eye over the top 5 dollar rises. We saw IJH, IVV, IHVV, SPY, and IJR. IJH is the iShares S&P Mid-Cap 400, and that tracks performance of the mid-cap sector in the US. That one has a market cap of $148 million or thereabouts, dividend yield of 1.32%. We saw a rise today of $1.71, which equates to 0.61% on quite a low volume of 963 shares traded. Casting our eye over the top 5 broadly, it's all US related, so effectively the inverse of the previous slide. So all up due to the fact that China's coming back to the negotiating table on the tariffs. Happy days. Top 5 dollar falls. What are we looking at here today? We're looking at ETPMPT, ETPMPM, GDX, VAP, and ETPMAG. No surprises there, mainly. VAP is a property index, Vanguard Australian Property Index. Let's quickly touch on ETPMPT. That is the ETFs Physical Platinum ETF, and that's backed by physically allocated metal held in the HSBC Bank in the US. That's quite a small ETF, trades around the $6 million mark. We saw a fall today of $6.20, which equates to 4.49% on relatively low volume of 846 shares traded. So, we've kind of run over why it's pretty much dominated by metals already, just due to the trade talks between the US and China. So let's look on now the top 5 number of trades. Today, number 1, we saw VAP, followed by STW, then VAS, IVV, and IAF. So VAP is the Vanguard Australian Property Securities Index ETF. That one has a market cap of roughly $1.3 billion. Dividend yield of 5.17%. Morningstar has this one as a goal, which is 5 out of 5 stars, if you want to think about it like that. Today we saw 252 trades. God, getting a bit out of control there. We saw a fall in the share price of $1.57, which equates to 1.7%. So property out of the good books. Okay, let's look at the top 5 ETFs of volume. No surprise here, we can see AAA, BNDS, STW, BNKS, and IEU. So AAA is one of the favourites. It's quite a heavily traded ETF. That is the Beta Shares Australia High Interest Cash ETF, and that one generates income by depositing funds in high interest deposit accounts in Australian banks such as ANZ, CBA, and NAB. That one has a market cap of roughly $1.7 billion. Dividend yield of 2%. Morningstar have a neutral rating on this ETF, which effectively is 2 out of 5 stars. Quite a large volume here of 477,900 shares traded. Pretty much the share price was flat, no change in the share price today at $50.09. Top 5 ETFs for value today. We saw AAA, STW, IEU, BNDS, and VAP. We've touched on AAA already. Today we saw a value of $23.9 million share traded. So as I've touched on before, AAA effectively, you can see people using that as a proxy to a bank account. So you get your dividend paid monthly in AAA, and as mentioned, it's about 2%, which is like a percent higher than what you're going to get in the bank. So you're sort of keeping up with inflation if you got some money in this one. Okay, let's dive straight into the spotlight, and that is SSO, the State Street SPDR S&P ASX Small Ordinaries Fund. So the objective, the State Street SPDR S&P ASX Small Ordinary Fund seeks to closely track before the fees, expenses, the returns of the S&P ASX Small Ordinaries Index. So the index is often used as an institutional benchmark for small cap Australian equity portfolios. The index is designed to measure companies included in the ASX 300, but not in the top 100 of the index, so they exclude the S&P ASX 200 stocks. Why on earth would you be considering this? Small cap companies tend to outperform larger companies over the longer term with faster growing revenues and profits. An index approach to stock selection offers greater efficiencies for investors, saving time and money. So let's take a look at the net asset value, $15.39, trading just above that at $15.40. Market cap of $23.3 million. Management fees, not too bad, I suppose, 0.5%. Looking for a dividend here, you'll see semi-annually, so January and July. Your dividend yield is roughly 2.32%, quite low because it focuses on the smaller companies and they don't tend to spit out that as much dividends, I should say, as the bigger companies. So at certain times in the economic cycle, smaller companies outperform their larger cousins, as we touched on the previous slide. Therefore, it follows that investors should be looking for and including companies that can beat the market in their overall portfolio. One advantage of looking at smaller companies is that they are generally under-researched and out of the mainstream media spotlight, so just not as many people looking at them. Given that the Small Ordinaries Index is really a subset of the ASX 300, which I touched on before, and I think your goal should be to keep your investments as simple as possible. I just buy an S&P ASX 300 ETF instead. I wouldn't necessarily bother with this one. So investing in the S&P ASX 300 ETF will still give you exposure to the small companies, as we mentioned. Also a larger dividend because the larger companies are included in the S&P ASX 300 index, and you can find the ASX 300 ETFs that tracks the ASX 300, I should say, at a cheaper price as well. So I think that's a really good option to think about, because you always think about the price of these things and what you're getting under the hood. So if you're still keen on checking out small ordinaries companies or smaller companies and ETFs that track those ones, have a look at VSO. I think VSO is a better option than SSO in my own humble opinion. Also check MVE. That one is sort of like a small to mid cap type focused ETF. Quite possibly a better option as well. You get a bit better dividend and a little bit cheaper price. So top 10 holdings, you've got NIB, Steadfast Group, Independence, Harvey Norman, Saracen, Metcash, Appen, Regis, Fisher and Paykel Healthcare, and Cromwell Property Group. I mean, probably one of the negatives about this ETF as well is the fact that you do have quite a lot of mid-size resources company included. So Independence Group, Saracen, Regis are all, mining companies, mining exploration companies, and they have a lot of volatility, and they're also quite linked to the commodity cycles as well. So that can actually drag this smaller index down quite substantially. Something else to keep in the back of your mind. For me, I don't think the performance of this ETF's been that great since inception either. It's picked up most of its gains in effectively this year, so the year to date. So it's up over 15%, and that's where it's picked up most of its performance. So if you've owned it over the last 5 or 6 years, it hasn't really done that great. Definitely do your research. As always, you want to make sure that we're making the right decisions and at least getting across what's actually available in the market. Hi guys, yes, this is our little standard disclaimer. I do not know your personal circumstances, and this is not financial advice. I'm not trying to promote any particular thing here. It's educational and just showing you guys what's out there and what the possibilities are. So please take that into consideration. My mission is to crack your financial sky by demystifying the world of finances. We're here to give you information so you guys can do that. Give me a thumbs up, hit the subscribe, smash the bell so you know when all the videos are coming. Hopefully we're helping out with the information we're providing, and at least giving you guys a little bit of encouragement to go out and have a look and take charge of your own financial world. Ciao.